Unit 3. Basics of Bookkeeping, Bookkeeping Rules. Bookkeeping is the most important part of accountancy. It is orientated in the past, and only records business events. Bookkeeping is a business function whose task it is to track business changes in business operations that reflect the assets, liabilities, capital, revenues, and costs of each business entity. Recording business changes are based on business documentation, i.e. a set of documents that follow a certain business change, input, output, to determine how certain changes have occurred. The aforementioned documents contain all the information that is required for the bookkeeper to work successfully and monitor the business changes. Bookkeeping is a demanding task that does not suffer superficiality and improvisation. After reading this unit, you will be able to understand the basics of bookkeeping and bookkeeping rules. Realize the differences between accountancy and bookkeeping. Learn what is an account plan. Bookkeeping is part of accountancy in which records of business events are recorded in business books using the dual bookkeeping method. In double-entry bookkeeping, business changes are reported that lead to an increase or decrease in assets, liabilities or capital. It is important to note that a business change has to be recorded and must be worth value. The principle of double-entry bookkeeping is based on the fact that any business change leads at the same time to an increase in an asset item while simultaneously reducing another asset, liability item or capital. Bookkeeping is the daily entry of business changes into the accounting system, in the recording and classification of routine transactions, while the accountant must have a wider range of knowledge and skills. Accountants must understand financial reporting, many regulations, in particular income tax rules, value-added tax, accounting standards, and be able to present all types of accounting information to managers, present financial statements and offer alternative solutions that would improve and optimize business operations. Accounting can be defined as the most important source of information about the company, i.e. a comprehensive system of records in which plans, records, controls and analyses of the assets and operations of the company can be performed, and on that basis, compiles the accountancy and financial statements. Accounting is the skill of recording, classifying and shortening the presentation in the cash units of expressed business transactions, and interpreting the results. Accounting is a service function that collects, processes and presents accounting information about business operations and interesting users. The account plan appeared in accountancy for the first time at the end of the 19th century, while its more significant application began in the 50s of the last century. The account plan is an instrument by which the main book items are sorted in such a way that the user can easily and unorganized read what is recorded in the business owner's main book. This is achieved in such a way that each group of items in the balance sheet carries its own broader range according to the previously established accounting plan. The way entrepreneurs make a computational plan is different in some countries. Hence, the obligation to apply a computational plan may be regulated in the sense that it is recommended to apply an account plan. Elaborating on the content of an account plan, an entrepreneur and the state establishes an accounting framework. The state prescribes the content of the account plan for which the required obligations have been prescribed. In Croatia, pursuant to the Accounting Act of the 1st of January, 2017, the obligatory contents of the account plan have been determined. The unique framework plan covers the classes and accounts and synthetic accounts that are applied for the purpose of recording bookkeeping changes, including their numeric and lowercase and off-balance sheet accounts, all of which must be allocated in accordance with the requirements applicable to the preparation of the financial statements. Accounting Act, Article 11, Paragraph 1, NN, 78/15. The business plan's contingency plan must be drawn up to provide data for separate and consolidated financial statements and must comply with the prescribed framework plan. The entrepreneur may, if necessary, extend the outline plan during the business year. If the account list does not change with the first day of the new reporting period, the entrepreneur may continue to use the contingency plan he applied in the previous reporting period. Accounting Act, Article 11, Paragraph 2, NN 78/15. The principles that are the basis of the classifications of the account plan, as well as their positions in the balance sheet, the profit and losses of the account, and other financial statements. The basic classification of positions are: assets, capital, principal and liabilities, obligations, expenses, income, the result of the current period. In Croatia, as of the 1st of January 2017, a computational plan will be applied in the principle of classification of accounts, according to the functional principle of the allocation of positions. In practice, the following principles still apply. Balance sheet. Combined. Functional principle. The concept of this principle is to input positions according to their movement in position conversions. Developing account schedules according to the functional principle below. Balancing principle. The characteristic of this principle is the account plan in which positions are classified in the balance sheet and in the income statement. This means first entering the accounts of the assets and then the liabilities, next the expenses of the accounts, and then income and operating results. The combined principle, applying this principle to the accounts, is divided by a combination of the function and balance principles. In order for the financial statements to serve their purpose, or to give a true and fair view of the company's state of affairs, the accounting principles and assumptions serve as a starting point for the development of accounting standards and policies. Based on the Croatian accounting standards of accounting and the IAS-1 presentation of financial statements, the general principles of financial reporting are: unlimited business hours, occurrence of events, significance and compression, consistency, materiality, comparability, caution, clearing, balance continuity, initial balance sheet, separate measurement of items, unlimited business hours. This principle is based on the assumption that an entrepreneur operates without limits over time, and that he intends to do business in the foreseeable future, meaning that he does not intend to liquidate or substantially reduce the scope of his business. Occurrence of events. The significance of this assumption is that the balance sheet items are recognized when a business event occurs and new cash or equivalent is received. These assumptions are the basis for the preparation of all the financial statements, except the cash flow statement 1.3.3. Significance, materiality, significance and compression. Based on this principle, it is necessary to distinguish which position or information is significant, and whether it should be presented separately in the reports, or displayed grouped with other positions. The measure of the item is significant if its disclosure could affect the user making a business decision based on financial statements. Consistency. This principle requires the accounting policies use recognizable and measurable positions in the financial statements, which are then applied during multiple accounting periods. Otherwise, accounting policies could become instrumental in manipulating the financial statements. Purchase expense. Based on this principle, products and services cannot be worth more than the price they were purchased for. However, it is permissible for an undertaking to use other methods of measuring asset positions for evaluation, for example, when recognizing and measuring the positions of the financial statements. Comparability. The user of the financial report should be able to compare the report with the reports from the previous period, as well as with other reports. Caution. This principle implies that asset and income items may be slightly underestimated, and liabilities and expenses slightly overvalued or anticipated, yet anticipating loss. This does not mean that this principle allows the creation of hidden reserves, i.e. intentional undercutting of assets or revenues or deliberately overestimating liabilities or expense. Decision on publishing the Croatian Financial Reporting Standards, NN 30/08. Assets, liabilities, revenues and expenditures should not be abolished unless the requirement is exceeded or the standard allowed. Decision on publication of Croatian Financial Reporting Standards, NN 30/08. In income and expense items, the payment can only be made if this is required or permitted by the IAS, or supporting information can be found in the financial statements. Balance continuity, initial balance sheet. The starting balance for each business year corresponds to the balance sheet of the previous year. Decision on the publication of the Croatian Financial Reporting Standards, NN 30/08. Separate measurement of items. Items of assets, liabilities and capital are measured separately. Decision on publication of Croatian Financial Reporting Standards, NN, 30/08. The organization of accounting in business entities is a complex process and depends on a number of factors that can be internal or external. Internal factors are different in each business subject and depend on the business involved, the size of entrepreneurs, management and so on. External factors are accounting regulations, which include the Accounting Act, International Accounting Standards, International Financial Reporting Standards, and in Croatia, the Croatian Financial Reporting Standards. The Croatian Financial Reporting Standards are the accounting principles and rules that applied by the accounting profession, and are used when drafting and presenting the financial statements of the decision on disclosure to the Croatian Financial Reporting Standards NN 30/08. Consequently, recording of business changes in accounting records has not been left to the entrepreneur's discretion, but is regularly regulated by standards. The Croatian Financial Reporting Standards are the basis for the preparation of the financial statements of small and medium-sized enterprises in Croatia, and are based on international financial reporting standards. The Croatian Financial Reporting Standards are similar to the International Financial Reporting Standards, and are in fact just a simplified version. Since most small and medium-sized entrepreneurs in Croatia find that the International Financial Reporting Standards are overwhelming and too extensive, as the IASB has failed to set standards for SMEs, a working group led by Prof. Drsc. St. Jep and Tadijan Sevic, created the Croatian Committee for Financial Reporting Standards. If the solution cannot be found in HSFI, Croatian Committee for Financial Reporting Standards, it is necessary to check the solution of the accounting records in IFRSs and IASs. Large companies have an obligation to apply the International Financial Reporting Standards, in addition to any businesses whose shares are listed on the stock exchange. The Croatian Financial Reporting Standards are adopted by the Financial Reporting Standards Committee, which is a 9-member professional body with 5-year mandates, nominated by the Ministry of Finance, appointed and dismissed by the Government of the Republic of Croatia. The Croatian Financial Reporting Standards, HSFI, are as follows. Large companies in the Republic of Croatia apply the International Accounting Standards and the International Financial Reporting Standards. The International Financial Reporting Standards, IFRS, are adopted by the International Accounting Standards Board, IASB, as outlined in the IASBs in 2001, as supplemented by the International Financial Reporting Standards, IFRS, International Financial Reporting Standards, NN, 140/06. Numbers and names of International Financial Reporting Standards, MSFI. Numbers and names of International Accounting Standards, MRS. In order to define which group an entrepreneur belongs to and which accounting standards apply, the Accounting Act, NN, 78/2015, the 17th of July, 2015, has classified the entrepreneurs in the manner defined below. Entrepreneurs are divided into micro, small, medium and large, depending on the indicators established on the last business day of the previous business year, for which the financial statements are prepared. Indicators which are the basis for determining which business falls into which category, are divided as such. The amount of total assets. The amount of revenue. Average number of employees during the business year. Micro-enterprises are those who do not exceed the boundary indicators in two of the following three conditions. Total assets 2,600,000 kunas. Income kuna 5,200,000. Average number of employees during the business year 10 workers. Small enterprises are those which are not micro-enterprise, and do not exceed the boundary indicators in two of the following three conditions. Total assets kuna 30 million. Income kuna 60 million. Average number of employees during the business year 50 workers. Medium-sized enterprises are those which are neither micros or small entrepreneurs, and do not cross the boundary indicators in two of the following three conditions. Total assets kuna 150 million. Income 300,000,000 kuna. Average number of employees during the business year 250 workers. Large enterprises are undertakings crossing the marginal indicators in at least two of the three conditions referred to in paragraph 4 of this article. Banks, savings banks, housing savings, electronic money institutions, insurance companies, reinsurance companies, leasing companies, UCITS fund management companies, alternative investment fund management companies, UCITS funds, alternative investment funds, pension managed companies, compulsory pension funds, voluntary pension funds, compulsory pension funds, pension insurance companies, retirement companies, factoring companies, investment companies, stock exchanges, central clearing companies, registers, settlement and/or settlement system operators and operators of the Investor Protection Fund, irrespective of whether the requirements of item 1 of this paragraph are met. Newly established enterprises and statutory enterprises shall be classified in accordance with paragraphs 2, 3, 4 and 5 of this article on the basis of the indicators for the period from the date of establishment or status change by the end of their first business year or the last day that period. For the purposes of classification, the undertakings referred to in this paragraph, the amount of revenue is converted to the annual level. Accounting Act, NN 07/15. The classification criteria implies the status and amounts as of the 31st of December of the year preceding the year for which the classification is to be made. Existing accounting systems in the Republic of Croatia are characterized by certain specifics. One of these specifics is the application of the appropriate accounting concept. The accounting concept represents the totality of the applied general accounting assumptions and the chosen accounting basis, i.e. the choice of the exact moment of recognizing transactions or events in the financial statements of the reporting period. Accounting concepts differ, therefore, it is important to define the exact moment when the measurement and recognition of elements of financial statements have been carried out, whether this should be at the time that the cash flow was created, or at the time of the business event. The accounting concept also points to the basis of measurement of the elements of the financial statements, i.e. whether the total economic resources, financial resources, only the current part of the financial resources, or the cash flow and the balance are measured. In the aforementioned scenario, two fundamentals of accounting concepts are distinguished: the cash concept, the cash principle, and the concept of the event, also known as the accounting concept.